Good morning. That was fascinating. Thanks, Effie. A lot to take away from there. I'm definitely going to look at checking out my health insurance this month. Can I get my notes ready? I'm going to talk today about superannuation. I'm going to talk about superannuation, and I'm going to talk about three concepts to do with superannuation. The first one is the power of compounding. The second is about life cycle investing. And then the third concept is about diversification. And diversification, I think, really is that superpower of industry superannuation funds. Oh, God, how do I change the slide? There we go. It's not that hard after all. In my presentation today, I'm going to talk about some projections. Now, this is analysis that my team has done. And in the analysis, we're using Aware Super's investment options to do that modelling. But the concepts I'm going to talk about are universal. They can apply to any superannuation fund that you're invested in. I'm also going to talk about retirement outcomes. And as with Effie, the information that I'm going to give you is general information. It's not related to your personal circumstances, but at Aware Super, we've got a really wide range of help and advice offerings, and I'd encourage you, if any of these topics are relevant or spark some interest, please reach out, check out our website or give us a call because, we'd love to talk to you about your own personal circumstances. So for a typical Aware Super member who joins the fund at the start of their career, 2/3 of the money they spend out of their super savings is going to come from investment returns. 2/3, that's really powerful. Getting the right investment strategy makes a huge difference in the type of retirement you get to enjoy. Our job at Aware is to invest those savings to get the best return that you can so that when you're ready to retire, you can have the life that you've earned. The power of compounding happens over time. And to get the benefit, you've got to have that long-term strategy right. As Effie said, the markets go up and down. In the last month or so, we saw to the trough last Thursday, shares were down about 10%. And if you're focused on the ups and downs in the market, trying to guess whether next week's going to be up or down, it's going to take away from your long-term strategy, and that can be really damaging. In fact, we've done some modelling that looks at the impact of big market falls in your superannuation. If you experience, say, like a global financial crisis, for example, the markets were down 40%, it took a couple of years to recover. If you experience a global financial crisis in your superannuation savings journey, depending on your age, it can actually be a positive impact on your retirement savings. Like Effie said, the share market is offering you discounts. You're able to buy these excellent companies for lower prices. In fact, if you have a global financial crisis at 25, 35 or 45, so long as you stay in work and you stick to your long-term strategy, keep contributing, your retirement income can be 2 to 3% higher because you've been able to take advantage of buying those shares at a discount. The first concept I want to talk about is a life cycle investment strategy. I know this is a really complicated slide, but please stick with me because I think the payoff is worth it. The white shape that you see there that looks a bit like a shark fin, that's your superannuation balance. Yeah? On the left-hand side, it starts out pretty low, but you're contributing, you're working hard, you're contributing your super, and it gradually goes up over time. You can see that growth rate starts to accelerate. The curve goes up just as you move through and approach retirement there. That's the power of compounding I was talking about before. After about the age of 45, your money starts working harder and your balance goes up by more than the returns on your investment contribute more to the growth in your balance than your contributions themselves. So once you reach that point, the power of compounding really starts to kick in. And then when you retire and you start drawing down on your savings, for a typical Aware Super member, that happens around about the age of 65. But you can see retirement is still a long time. For most people, it's a really long and enjoyable period of their life. And to make the most of that retirement, you need to stay invested to make those savings last longer. So what do we mean by life? Actually, so on that point, yeah, you need to make your savings last longer. Of the 2/3 on the previous slide, half of that, or a third of the total money that you're going to spend out of your pension account, out of your retirement income account, is going to come from investment earnings after you've stopped working. So you need to remain invested. If you get freaked out by the ups and downs in the share market and you put your money in cash, you can do that and maybe that'll help you sleep better, but you're going to have to take a pay cut in retirement, and nobody wants to do that. So what do we mean by a life cycle investment strategy? It's the strategy that we employ in our default option at Aware Super, and there are some other large funds who do it as well. Essentially, at the heart of it, it means that when we think about the investment strategy for our members, we think about who they are. If you're down this end of the chart, you're just starting out, you're starting out in your career, you should have a different investment strategy than someone who's just about to retire, because you've got a different time horizon. Like I said, if a GFC happens when you're 25 or 35, that's good for you. You get to contribute more. And so if you've got a portfolio of high growth assets, you get to buy those assets even cheaper. But as you approach retirement, you need to start diversifying, and that's what we do with a life cycle investment strategy. High growth assets when you're younger, maximise your return, get as many different sources of growth into your portfolio as you can. You don't want to be weirdly stuck in some small corner of the world that doesn't experience growth. You want to make sure that you get that long-term compounding growth. About 10 years out from retirement though, in that modelling I talked about before, about a GFC, if you experience a GFC when you're 55, that can actually have an impact on the amount of money you get to spend in retirement. Not massive, it's only a little bit less than 1%, but because you don't have as long to recover before you need to start spending your money, a GFC can really impact in that later life. So what we do in our life cycle design is from the age of 55, we start to introduce diversifying assets to lower the overall risk of the portfolio, so that you've already accumulated a pretty decent balance by the age of 55. So now it's just as much about holding on to what you've got as trying to get really high returns. So we introduce assets like bonds and cash, and they'll help to offset some of the volatility that you see in markets. Once you've finished working, you still need to remain invested, as I said, but it's even more important then to manage the downside risks. And so for our retired members and our pension options, we've got a range of other strategies which can really deliver positive returns when markets turn negative, so help to cushion that blow. Our retirees, they win by losing less when markets fall. If you don't lose as much when markets go down, you don't have to run as hard to catch up again afterwards. Everybody's rhythm in retirement is different, right? Everybody, on the accumulation side, it's pretty simple. Everybody wants to do the same thing. Invest as much as you can, grow your money as hard as you can, so that when you reach the point of retirement, you've got a wide range of choices open to you. But everybody's going to land at a different spot. Everybody's going to have a different amount of money, they're going to have different family circumstances, and they're going to have different aspirations for their retirement lifestyle. Retirement is individual, and you need to, I think it's really worthwhile, as Effie said, at that point of your life to reach out to your superannuation fund and ask them for advice. It can be as simple as, how should I be invested? When can I retire? How much can I afford to spend in retirement? All of those kind of questions, your superannuation fund should be able to help you answer. I know this looks a bit complicated, but the good news is you don't have to do anything about it. At Aware Super, this is our default strategy. So if you elect to join the default fund, then we'll do all this hard work for you. This is the payoff. For that typical member, that 21-year-old joining the fund in their first job, we've modelled a typical member's salary, contribution rates, retirement rate, retirement date, and so on. For that typical member, because of that life cycle design, she'll have $113,000 more when she retires than if she was just in a balanced fund for her whole contribution journey. It's a big difference. Yeah, for someone who joined at the same time, had the same career path, and was just invested in a balanced fund, the member in a life cycle strategy would be able to retire 2 years earlier. Or if they retired at the same time, she'd be able to have this epic holiday in their first year of retirement. So getting the strategy right makes a real difference. The second concept I want to talk about is diversification, and Effie touched on this as well. The pie charts here represent two different stages of our life cycle design. On the left-hand side is our high growth option. This is the one for those younger members, everyone under the age of 55. I'm glad that under 55 is considered young, by the way. I'm turning 50 this year, so it's good to be in the younger category. Not many places where you tick those boxes are you considered young at 50, but the high growth option, as you can see, the colours aren't very helpful, I'm sorry. This is all branding. I wish they were a little bit more different, but you can see, starting at the top and going clockwise around, the pink and the purple, the first two bars there, the first two bits of the circle there, those are shares. So Australian shares and international shares. We think that you can get 9.5% returns out of shares over the long run. And so we want to have a lot of those in our portfolio. That's how we can really get that long-term, strong compounding above the rate of inflation. The next little bit there is private equity. I'll talk about private equity in a bit, actually. We've had really good investment outcomes from investing in private equity. These are companies which aren't listed on the stock exchange. You can usually buy them at a really early stage in the company's life when the growth rate's really high and the opportunity for value creation is enormous. The next couple of bars are infrastructure and property. And we get really good returns from those asset classes as well, not that far off the returns that we expect to get from equities, from shares. The difference is that the valuations, the returns are a little bit more stable than you get in the share market, and they also bring us exposure to some return streams or some market factors which aren't as easy to get in the stock market. So things like good linkages to inflation, for example, which it's obviously quite topical at the moment with inflation on the rise again. On the right-hand side, you can see this is our conservative balanced option. So at the point of retirement or at age 65, the end of our life cycle de-risking pathway, this is where our members will be invested. We've still got the shares, the first two parts of the circle there. We've still got the private equity, we've still got the infrastructure, but we've got a much greater exposure to defensive assets. We've got a large allocation to cash, we've got an allocation to bonds, we've got an allocation to credit. And the reason we do that is because when you're heading into a period of weaker economic growth, if there's a recession, for example, then those are the assets which will help to buffer the performance of the riskier assets in the book. So in a recession, you can expect your shares to fall 20, 30, even 40%. But the defensive part of your portfolio, like the cash will probably stay where it is. You might get 2 or 3% return. The bonds will probably give you a 6 to 10% return. And when you've got enough of an allocation to them, it can turn a recession or a financial crisis into a much more survivable event for someone approaching retirement. On the next couple of slides, I'm going to give some examples of assets which can further enhance that diversification and which are really hard to access as an individual investor. I liked the way Effie was talking about exchange-traded funds. For your non-super money, that's a really excellent way to build wealth. Low-cost exposure to a really diversified portfolio, low-cost, liquid, great way to compound wealth. But you don't get to have exposure to some of the unlisted assets that we can deliver in an industry super fund. The first one I want to talk about is a company called Canva. Canva, it's been, I think, without a doubt, our most successful investment at Aware Super, and one of the great Australian success stories. This is a graphic design platform. Some of you in the room may have used it before. It's It's got around 200 million monthly users, so it's a big global company now. And the latest valuation was, well, they raised money last year at a valuation of around $50 billion. It's an enormous Australian success story. We were a very early investor in Canva at Aware Super. We invested with a fund manager called Blackbird, and then we put some money in alongside, and then we followed that on with another investment and then another investment. But we're still talking really small amounts that we've put in, and the returns that we've had have been absolutely phenomenal. We've made over 30 times our money, or we've made over 30 times your money in Canva. We've taken many multiples out through selling shares, and we've still got many, many multiples of our initial investment in there. Like I said, private equity means you get to access companies really at the ground floor when they're just about to experience that phenomenal hockey stick growth rate. And it's much harder to find companies like that on the stock market. In 2023, we opened our first office overseas in London. The superannuation industry has been growing. We're the third largest fund with $190 billion in assets for 1.1 million members. We're still finding lots to do in Australia. There's lots of great investment opportunities here. But looking forward into the future, we know that it's going to get harder for us to find the assets that we need to get those long-term returns, if we're just focused on the local market. And fly in, fly out just doesn't work. If you want to build networks, if you want to originate new transactions, you need to have boots on the ground. You need to bring something to the table other than just, hi, we're Aware Super and we've got some money to spend. One of the first things that the team did, one of the first assets that the team found, is this business called EU Networks. And it's in a space that we really like. It's a data infrastructure asset. It's got around 45,000 kilometres of fibre optic cable across 17 countries connecting over 500 data centres. That scale is a real moat, a real competitive moat for this business. It helps attract customers because they've got so many routes to connect their data centres that the capacity is just so much greater. We can see real opportunities to grow this business into the future and continue to get really strong returns. The data infrastructure sector is just so exciting. We've all got phones in our pockets, iPads. Everything that we do is data informed these days, and it's not hard to see that the data intensity of the economy is just going to continue to increase. And when you can find strong tailwinds like that, it's a really great way to invest. The last asset I have here to talk about is a little bit closer to home. It's only a small one. It's only a small asset, but it's a property development, a residential property development here in Perth. Our property team have been quite innovative. There's really not been a lot of superannuation or institutional capital invested in the residential property market in Australia. There are huge markets in the US and in Europe. We own some assets in the US, we own some assets in Europe. But in the Australian market, it's just been a lot harder to do. Our property team, probably about 7 years ago, really set out to see if we could solve this problem. And it hasn't been easy, I've got to say. Today, we've got around 500 dwellings in the portfolio, with another 1,500 or so in development across Australia. And a lot of those are offered as key worker housing at affordable rents, 20% below the market rent. We're able to do that initially because we were able to buy at really good prices at a time when the property market was a bit weak. We were able to step in opportunistically and provide that capital to the market. But more recently, we've been able to do it because we've developed our own property development company. And so we're able to start from scratch, identify a project, take it through to completion and earn that developer margin. These are the kind of things which are just much harder to do in a portfolio that you're managing yourself, and having a team of investment professionals to do it for you means that you can access those extra returns. So I hope this has been useful for you. The choices that you make about where your super is invested are going to have a significant impact on the type of retirement you get to enjoy. Sadly, most people in Australia are disengaged from their superannuation. I say sadly because, like, for me, it's the most exciting thing in the world. I know that that's not the case for everybody else who's out there. But getting that decision right about where your super's invested, making sure that you're in the right strategy, is one of the most important things that you can do. And I'd encourage you to speak to your children and your family and friends and make sure that they know that too. And remember, to get the most out of your savings, you need to have the right amount of risk at the right time. If you're not planning on retiring in the next few years, you should be taking advantage of that long-term investment horizon, because the payoff is absolutely huge and you don't have to do anything clever to get that extra return. And then to make your money really last, you need to have access to a diversified portfolio across growth and defensive assets. And this, I think, is really that industry super fund superpower, being able to access that diverse range of assets. That was the end of what I had to say. I'd love to get some questions. I can talk about our portfolio. I can talk about what's going on in the world. Test me out.
Okay, ladies and gentlemen, Michael will be staying around for morning tea. Is that right as well? Will you be here for the next half an hour or so? Or
I'll be able to stay for a few minutes.
A few minutes, okay. Might be able to catch him at the end. But if you otherwise, is there a question or two before we break for morning tea, or hear from Bruce Lorimer? Anybody want to throw something at Mike? It's very timely, of course, for a lot of people, but also with the downturn in some of the super funds over the last couple of weeks, but it seems like it's bouncing back.
Yeah, I was looking at the unit prices of some of our investment options the other day. So from the peak on 21st of February to the bottom last Thursday, the share market had fallen about 10%, right? And God, it had been a pretty volatile 10%, right? Like every day there's headlines. I remember I got up at breakfast, and I'm one of those sad people. The first thing I do when I wake up is I look at my phone. There's this alert on my phone saying Trump's doubled the tariffs on Mexico and Canada. I'm like, oh gee, that's not going to be good. By the time I was having breakfast, he'd changed his mind and they were gone. So anyway, markets were down 10%. Then I had a look at the unit prices of our funds, and that diversification makes a real difference. Our high growth option, the riskiest option we've got, was only down 4.8% or something. So already that diversification works for you, because we've got things in there like foreign currency exposure. When equities sell off, the Australian dollar tends to go down, and if you've got overseas investments which are denominated in foreign currency, that helps to offset the losses. And our conservative balanced option was only down about 2.4%. So the power of those defensive assets providing diversification makes a big difference.
Oh, that's great advice. All right, well, we might wrap it up, and Michael will be here for a couple of minutes after the session as well. So, ladies and gentlemen, I'm about to give him his food bank voucher that we're helping feed Australia, Michael. So, round of applause for Michael Winchester. Aware Super, thank you.
Thank you for your support.